Home loan rates have hit a new low, thought to be the cheapest in 40 years. The ASB's cut its floating mortgage rate to 5.75%, a saving of around $20 a week on a $200,000 loan. So what does that mean for the home buyer? What will the other banks do, and should you fix or float? Well, joining me in the studio now is Bernard Hickey, Managing Editor of Interest.co.nz. Bernard, why do you think the ASB's made this move?
Well, there's a couple of reasons. Next week, the Reserve Bank is going to make its decision on interest rates, and the ASB thinks it may actually cut. So it's jumping in ahead of time. Also, there's been quite a lot of pressure from the Reserve Bank and from politicians for the main banks to pass on recent cuts in the official cash rate. And finally, on international markets, the funding costs for ASB and for the other banks have actually been falling in recent months because international financial markets are a bit calmer and other banks are demanding a little bit less of a premium for the borrowing they do to our banks.
Do you think the ASB is right? Will the Reserve Bank drop the official cash rate from that 2.5%?
Well, they're a bit out on a limb here because their economist is the only one saying that they will cut from 2.5%, which is a record low, to 2.25%. We'll see on Thursday, and I think it'll be a key factor for the other banks and whether or not they follow ASB. They'll wait to see whether the Reserve Bank cuts again on Thursday. My pick, and the pick of most other economists, is that they won't. They'll be on hold. But we'll see.
So the other banks are more likely to follow the Reserve Bank decision rather than the ASB in this case?
Well, they'll certainly wait to see what the decision is and what the commentary is from the Reserve Bank Governor about interest rates in the future. They may follow the ASB because we've already had the BNZ cut its rate to about 5.8% or so, its floating mortgage rate, and now the ASB has gone to 5.7%. The others, which are ANZ National and Westpac, are still well above 6%. So they can afford to wait for a week or two, but maybe not too much longer, and that's where we might see the others start to pull into line.
What's your advice for those with mortgages? Is it time to fix or to float?
Well, it depends on your personal situation. If you're at that stage of life where you're paying off your mortgage regularly, you've got quite a bit of income coming in, or maybe you're just about to inherit or win lotto or whatever, you want to be able to pay back your mortgage quickly. The sooner you pay back the mortgage, the less you have to pay over the long run. But if you're very early in your mortgage and you're really strapped for cash, a lot of young first home buyers are in that position. They want the absolute cheapest rate and they want some certainty for a couple of years because they've got their own situations. That's when you need to look at a fixed rate. The issue for a lot of borrowers is what's going to happen to interest rates in the next couple of years. Because if interest rates are going to keep falling, you're probably better to stay on a floating rate. If you think interest rates are going to rise, or at least stay steady, a fixed rate makes sense. I think that interest rates are likely to edge up in the next couple of years and are unlikely to fall too much further for the floating rate. And that means for those people looking for the absolute cheapest deal, you're probably best right now on a fixed rate.
Okay, that's quite a big call when we have got a bank that's dropped to the lowest level in possibly 40 years.
Mm-hmm. But for them to fall further, you'd have to have the Reserve Bank to cut substantially. And already, those fixed and floating rates are around about the same level. And for just a few extra basis points, the certainty of having a fixed rate is probably better for the next couple of years. Given that rates, remember the Reserve Bank's cut them to 2.5%. That's a record low. And the suggestion they'll cut them much lower is pretty speculative. Also, the economy is starting to recover, not just here but globally. And when that happens, Reserve Banks are putting up interest rates. They're not cutting them.
But the gap between the official cash rate and even the floating rate we're talking about is still quite significant.
That's right, and that's because the funding costs for the banks overall over the last couple of years have increased. Not just on that international funding costs, but locally as well. The other story that a lot of people don't hear about is the fight for term deposits that's going on at the moment. The banks are fighting with each other and putting up interest rates for term deposits to get mums and dads' money through the door, and that means their costs are up a bit. So I think it's unlikely we're going to see big new cuts in those variable mortgage rates. This appears to me to be sort of an end of the process, one from ASB.
And just lastly, what about over the next 10 years? Can you forecast what you expect interest rates will do?
Well, over the last 10 years, interest rates have averaged about 8%. And for anyone who's taking out a mortgage right now, they're going to one of these open homes in spring and thinking, wow, I can afford that house at 6%. Got to take into account over the long run it averages 8%. And that means at some stage in the life of the mortgage, it's going to be 10%. And you better be sure you've got enough money to pay for a 10% interest rate.
Thank you very much for your advice. That's Bernard Hickey from interest.co.nz.